Welcome to today's asset allocation webinar. My name is Phil Huber, Head of Portfolio Solutions with Cliffwater. And in a moment, you'll be hearing from Steve Nesbitt, Cliffwater CEO and CIO. Just as a quick reminder, today's webinar is for research purposes only. It's not specific to any Cliffwater funds. So we'll leave ample time at the end for Q&A, but just be mindful any fund-related questions we can't answer directly. So with that, I will hand things over to Steve and take it away.
The webcast today, hope to cover just a few items, just a big picture on the macro environment. I'd like to get you caught up on past asset class performance, so basically how all the different asset classes have performed through March 31. That's when we have good private data. And then switch gears and look forward, provide you with our expected asset class returns on a go-forward basis, and then finish up with asset allocation. And I'd like to talk about our model portfolio I introduced about a year and a half ago, and then take your questions. So big picture, the economy is good, not great. Here we show quarterly GNP by quarter, break that down into different sub-periods. The most recent sub-period I call post-COVID period, where basically we've been growing at a 2% annualized rate. As you know, we had a negative first quarter. A lot of that seemed to be related to the tariff issue, but corporate earnings per share went down as well for the S&P 500. So we'll have to watch that fairly closely. But overall, the economy is avoiding recession and behaving in a pretty consistent way so far. In terms of different monetary and fiscal policy, I'd like to talk about monetary policy first. And basically, it continues to be restrictive. You know, we went through this post-COVID period where it was very accommodative. We show here two lines and a shaded area. The Fed funds rate in blue, got off the zero mark, and it's been hovering at 4 to 5% over the past couple of years. We match that against the 12-month trailing inflation rate, and we're now at a point where over the last couple of years we've had a positive spread, meaning there's a real return to cash investments. Today, that's if you look at the far right-hand side, Fed funds at 4.33, trailing inflation at 2.33, the spread being 2%. Historically, that spread has been 1%. We consider that neutral. So if Fed funds stands at up to 1% above inflation, we feel that's neutral. The fact that it's doubled that at 2% was a little higher earlier means Fed policy is restrictive, and it's a little bit unusual given that inflation is seemingly under control, but given deficits, which we show in the next slide. Projected deficits are close to $2 trillion on a go-forward basis. That's the CBO estimate. Basically, the government's going to have to finance significant debt on a go-forward basis, and that may be the Fed's concern right now, and why they're keeping interest rates high. So accommodative fiscal policy, restrictive monetary policy, maybe offsetting. We'll see. But so far, the GNP seems to be able to grow at a okay rate. Flipping to the capital markets, as you know, I always like to show this graphic. Basically, talk about how impressive capital formation has been in the U.S. This covers pretty much a century, starting in 1925 through June of 2025, compound annual return for stocks at 10.4%. Some of that, as I've said before, is PE expansion. If you take out PE expansion, it'd be about 8.4%. So again, we've gone through a couple decades where the market's gone sideways, but it eventually recovers and stays pretty much along a consistent upward path that is fairly attractive against inflation, shown there at the bottom. But the bond market, basically, in recent decades, we've used the aggregate bond index. Earlier periods, we just used long-term government bonds. But the return on bonds have been half that of stocks, 5.2% over this entire period. It really breaks down into a period of rising interest rates, low returns, and declining interest rates, high returns. We seem pretty much today at the long-term growth rate. And we'll talk later that yields right now are fairly attractive against historical averages. And again, cash as a long-term investment averages about 0.5% per year above inflation at 3.3% minus 2.8%, or roughly 0.5% per year. And then the next slide, I introduced this a couple quarters ago. A lot of differentiation in performance recently has been allocations to U.S. versus non-U.S. Stocks. I divide non-U.S. stocks here into emerging markets and developed markets, or EFA. And what this graph shows is basically, particularly if you look over the last 15 years, non-U.S. stocks have pretty much been flatlined. They've been resuscitated here so far in 2025. I think a lot of that is, or if not most of it, is just the fall in the dollar this year. But basically, my point in the past has been capital formation in the U.S. has been consistent, where it hasn't been in non-U.S. stocks. Also, the correlation between non-U.S. stocks and U.S. stocks has gone up. So lower return and not much help in terms of diversification. I think everybody's been rethinking their U.S. non-U.S. allocation in equities. And for us, I'll talk later. Basically, we're underweight in non-U.S. stocks relative to market caps. Just quickly, I introduced this slide on the last call on the same theme of U.S. versus non-U.S. The point here being on the top line, whether you're looking at price earnings ratios or price to EBITDA, the U.S. is expensive. A higher PE, higher EBITDA ratios, no doubt about that. There's almost a 50% sale on non-U.S. stocks. But if you look at the bottom panels, and particularly the bottom right, U.S. growth rates, EBITDA growth rates have been significantly higher than non-U.S. growth rates. So it's basically a growth versus value play. You probably want some combination, but our point is without the diversification benefit, we're leaning into U.S. stocks. I updated our records on the performance, basically all the major asset classes. I wanted to point out a couple things. First of all, the start date, September 2004, it's a little odd start date. It's a little more than 20 years. I picked it because that's when we first have good data on private debt measured by our Cliffwater Direct Lending Index. So basically, I set that out as the starting point to measure performance and risk. So if you look at this graph, compound annual return on the vertical axis, risk on the horizontal axis, the line connects cash returns and the Russell 2000 index. This is kind of from a U.S. investor perspective, the capital market line or the security market line. If you plot above, that's good. If you plot it below, not as good. And our focus as an alternatives advisor, manager, our focus, particularly with our fund offerings, has been on private debt, which we circled the Cliffwater Direct Lending Index, and private equity, circling the Cambridge buyout and private equity indices. So if we look over the last 20 years, we'd have similar results over the last 10. Basically, the thesis is that these private asset classes will do better than their public equivalents, and they have historically. I often compare the Cliffwater Direct Lending Index, if you look down at the Morningstar LSTA, but somewhat below the line at about a 10% risk level. Basically, the incremental return is over 4%. We consider that very attractive. And in the case of the Cambridge buyout index against the Russell, that's over a 4% delta. So again, our thesis is that these private asset classes, debt and equity, will substantially over time outperform their equivalent publics. Real estate and infrastructure, I also show those here. They're also attractive against the capital market line, maybe more to the order of 1.5 or 2%, but they show well against their public equivalents. For example, the NCREIF index falls above those slightly. The FTSE Nareit equity index, which has a much higher level of risk, is plotted to the far right. Let me move and talk about looking at both more recently and then looking ahead. So I've shown for each of the individual asset classes the year-to-date return. That is in the YTD 2025 column. Mostly black down this column. The S&P at 6, FTSE at 15.5, but most of the, if not all of the incremental return from non-US stocks has been to fall into a dollar. And if you go down to the bottom of the page, under other US dollars, the dollar's fallen 10.8% year to date through June, and which basically explains the 10% better return from the FTSE. If you look at rates, basically rates have fell materially, about 0.5% over the year so far this year, giving pretty good returns to fixed income. Short-term rates, because Fed funds were cut earlier in the year, T-bill returns are down a little bit. If we look at credit, basically, or public credit earning their yield, I show alternative asset classes. Basically, the private asset classes, private debt has done well over the 6 months ending March at 4.8. Private equity and private real estate are showing positive returns. Real estate has kind of turned around a little bit. So is private equity. In the adjacent column, we show the long-term L-T, long-term expected return for these asset classes. Not a lot has changed. We lowered our inflation assumption slightly. That lowered a lot of these asset classes, but generally they're pretty much in equilibrium. That shows up in the next slide, and where I show the relative attractiveness of stocks versus bonds. So basically, that's the big question: should I do risk on, risk off? And good proxies are stocks and bonds. What I show historically is the expected return on stocks in the blue line and the expected return on bonds in the green line. The expected return on stocks is pretty much always above bonds, as you'd expect. The average spread is about 3.5%, and at the end of June, the measured spread was 3.57. So what's the takeaway here? We're pretty much in equilibrium. If your benchmark is 60-40, we'd probably recommend you stay 60-40. If its benchmark is 70-30, it'd pretty much stay 70-30. That's unlike most of the post financial crisis period, where we were leaning into stocks vis-a-vis bonds. That has reversed. We're now in a neutral position. There was a short period of time where we favored bonds, but today it's we consider ourselves roughly in equilibrium. Turning to this slide, I find this topical because there's always a question with privates. Hey, what's going on with their valuation versus publics? Are privates being overvalued or undervalued relative to where they should be? And the problem has always been real estate. So public, I show in the top graph, private versus public real estate. This is the return from December 19, just pre-COVID, for private real estate, NCREIF, that's the solid blue, versus the public real estate is measured by NAREIT Equity Real Estate Index. And if you notice here, it's like there's total confusion. There are times when publics go down and nothing happens with private real estate. Sometimes they go in the complete different direction. This has compromised the confidence in many real estate funds, and has been disconcerting to even long-term investors, wondering whether they should get out or not. In the bottom left-hand graph, we show public versus private debt. Again, private being our direct lending index, public being the Morningstar LSTA index. They pretty much mirror each other, though their slopes are different. The slopes are different. We expect them to be, because privates have yields about 3 to 4% net of fee higher than publics. So that doesn't seem to be at first glance any problem with valuation on private debt. On private equity, on the right-hand side, again, they're not going in opposite directions. The amplitude on the Russell 3000, the volatility is much higher. We always argue because you're getting paid for liquidity, and the price of liquidity is pretty volatile. But they never seem to go in different directions. So I wanted to update this for you all, because valuation is always a big issue when you're dealing with particularly semi-liquid vehicles. So final slide, and then pleased to take questions. So I introduced this model portfolio about a year and a half ago, just to kind of put down on paper, how we would construct a portfolio. I know people have tens or hundreds of model portfolios for individual circumstances, and no one size fits all. So I'm violating that principle. But basically, our feeling is particularly for retail investors, this is how we would, on a first order attempt, suggest an allocation across asset classes. So in public stocks, 40%. As you can see, we're heavily weighted to U.S. stocks. Part of that also is, the world is become an unsafe place. Particularly, what do I mean by that? The risk of different countries, bad things happening in individual countries. I think that has heightened. That started with the Russian invasion of Ukraine, but I think there are a lot of other examples and potentials, particularly with China. So, but anyway, 40% stocks lean to U.S. Public fixed income. We have a 25% allocation. We like, particularly with a flatter yield curve, we like a 5% allocation to cash. The 20% in fixed income, we like that primarily because the real return on bonds is now positive. I talked about the 2% earlier in the presentation. So you are getting paid to take duration risk. So hence our allocation to 20%. Obviously, taxable investors will look for relief in the municipal market, but generally we like this 20% allocation to bonds. And then in private debt and private equity, 20 and 15%, so a total of 35%. I think that is, that's underweight relative to institutional allocations, probably overweight relative to individual investors. We're probably my earlier slide showed that. Let me go back there if I could. My previous slide showed on private versus public real estate. Basically, we've reversed. We were very concerned a few years ago because private values were way above public values. That reversed a couple of quarters ago, and now we have public values above above private real estate values. So we're starting to become much more interested in private real estate. So don't be surprised if we add an allocation sometime in the next 2 quarters to get exposure there. But right now we're happy with that, with the 20 and 15. Let me just finally point out, we show performance over this 1.5-year period annualized. The model portfolio has done on an annualized basis 15.1%, which is better than what we would have thought. I think basically our expectation is something more on the order of a 10% return, compound annual return from this type of model portfolio.
Great. We'll wrap up there. There's a handful of questions we weren't able to get to today, a few that we just need to address offline, but our team will follow up with that. We thank you as always for joining this asset allocation webinar. We hope you all enjoy the rest of your summer, and we'll look forward to seeing you again in a few months. And yeah, Steve, anything else you want to add before we sign off?
Enjoy your summer.
Thanks, everybody. Have a great afternoon.